Ladies and gentlemen, welcome to Finance Reborn. Turn off every distraction. Put your phone on silent. Close every browser tab. Because what I'm about to reveal exposes the most desperate intervention in precious metals market history. An intervention so extreme, so unprecedented, that the institution responsible is praying you never understand what it actually means. This is not speculation. This is not theory. This is documented exchange action recorded in official trading logs and regulatory filings. The CME Group, the organization that operates COMEX and controls silver price discovery for the entire Western financial system, just halted silver trading. They stopped the market. They froze price discovery. They prevented willing buyers and sellers from transacting. And I need you to understand something critical before we go any further. Exchanges do not halt trading because markets are functioning properly. They halt trading when something is broken so severely that continued price discovery would expose a truth they cannot allow the world to see. Right now, the CME is hiding something so damaging to their credibility, so threatening to the paper silver system, that they chose the nuclear option of halting trading rather than allow prices to reflect reality. Because while you were sleeping, while you were living your normal life, the silver market experienced a dislocation so violent that the world's largest commodity exchange decided transparency was too dangerous. They decided that you, the investor, should not be allowed to see real-time price discovery. They decided to hide the truth behind a trading halt. I'm here to show you exactly what triggered this halt, what the CME is desperately trying to conceal, who benefits from hiding this information, and most importantly, what this emergency action reveals about the true state of the silver market. Now, before we dissect what the CME is hiding from you, I need you to do something for me. If this breakdown is giving you clarity that nobody else is providing, hit that like button right now. It helps this message reach people who desperately need to understand what's happening behind closed exchange doors. And subscribe if you haven't already, because the implications of this trading halt will reverberate through precious metals markets for months. Click that notification bell so you don't miss a single update. Let me walk you through exactly what happened, because the specifics reveal everything about why the CME is terrified. The halt occurred during Asian trading hours when liquidity is typically thinner, but price discovery continues through electronic trading. Silver futures were moving aggressively higher, breaking through multiple resistance levels in rapid succession. The move was orderly. Bid-ask spreads remained functional. Trading volume was elevated, but not extreme. Then, without warning, the CME triggered what they classify as a velocity logic halt. Trading suspended, order books frozen, price discovery terminated. Let me explain what velocity logic means, because the CME uses technical language to obscure what is actually happening. Velocity logic halts are triggered when prices move too far, too fast. The exchange has preset parameters. If prices breach these parameters within defined time windows, trading automatically suspends. The official justification is market stability, preventing flash crashes, protecting investors from extreme volatility. But here's what the CME doesn't want you to understand. Velocity logic halts work both directions. They can trigger during crashes or during surges. When silver crashes, halts protect short sellers from margin calls they cannot meet. When silver surges, halts protect short sellers from losses they cannot afford. Notice the pattern. Both scenarios protect the same group, the institutions holding massive short positions who benefit from artificial price stability. The halt that just occurred happened during a surge. Silver was breaking higher, and the CME decided that price discovery had to stop. Ask yourself a simple question. If the move was driven by genuine market forces, if buyers and sellers were voluntarily transacting at higher prices, why would the exchange intervene? Who benefits from preventing prices from rising? The answer is obvious. The bullion banks holding billions of dollars in short positions benefit. The institutions who have sold silver, they don't possess benefit. The CME itself benefits because a short squeeze would expose the inadequacy of their delivery mechanisms. The halt was not about market stability. It was about protecting the paper silver system from exposure. Now here's the question nobody in the mainstream financial media is asking. What specifically triggered the halt? What price level was silver approaching that terrified the CME into emergency action? The answer reveals everything about the true state of silver supply and the desperation of institutions defending price suppression. Based on trading data immediately before the halt, silver was approaching a price level that would have triggered massive margin calls across the bullion bank complex. We're talking about a threshold where short position losses would have exceeded available capital for multiple major institutions. Let me explain how this works, because understanding the mechanics reveals why halts are necessary for system survival. Bullion banks hold concentrated short positions in silver futures. These positions are leveraged. For every dollar of capital, they control many dollars of notional silver exposure. This leverage amplifies profits when prices fall. It also amplifies losses when prices rise. As silver prices increase, Short sellers must post additional margin to maintain positions. If they cannot post margin, their positions are forcibly liquidated. Forced liquidation means buying to cover short positions. Buying pressure drives prices higher. Higher prices force more liquidations. More liquidations drive prices higher still. This is the short squeeze dynamic that the CME will do anything to prevent. The trading halt occurred precisely when silver reached the threshold where this cascade would have begun, not coincidentally, precisely. The CME's algorithms identified the danger zone and terminated trading before the squeeze could ignite. What they're hiding from you is simple. Silver's natural price, determined by willing buyers and sellers, exceeds what the short seller complex can survive. The only way to prevent their destruction is to prevent price discovery itself. Let me show you the smoking gun that proves this halt was about protecting shorts rather than maintaining stability. Look at what happened when trading resumed. This is the tell that exposes everything. When the CME reopened silver trading, they implemented what's called a collar around the pre-halt price. This collar restricts how far prices can move from the halt level. Buyers willing to pay higher prices cannot execute. Their orders sit in the book, unfilled, while the exchange prevents prices from reflecting their demand. If the halt was genuinely about stability, about preventing disorderly markets, the reopening would allow natural price discovery. Buyers and sellers would transact at mutually agreed prices. The market would find equilibrium. Instead, the CME reopened with artificial constraints that continued suppressing price discovery. They didn't restore the market. They reopened a managed market designed to prevent prices from reaching levels that would destroy short sellers. Additionally, examine the timing relative to physical market premiums. During the halt, physical silver dealers reported surging demand. Premiums over spot prices expanded dramatically. Customers were willing to pay significantly above the frozen futures price to acquire actual metal. This divergence is devastating evidence. The paper price was frozen. The physical price continued rising. Two markets, supposedly tracking the same commodity, moving in opposite directions because one was free and one was controlled. The CME is hiding the fact that the paper price they manage bears no relationship to physical silver reality. The halt prevented this divergence from becoming visible in official price data. But the physical market told the truth while the paper market was silenced. Now, let me connect this to the bigger picture because this trading halt is not an isolated event. The CME has implemented velocity logic halts in silver with increasing frequency over the past year. Each halt occurs when prices threaten to breach levels that would trigger short covering cascades. Each halt is followed by managed reopenings that prevent continuation of the pre-halt trend. This is not coincidence. This is not algorithm malfunction. This is systematic intervention designed to maintain price levels that the physical market has already rejected. And the pattern reveals something even more troubling. The intervention frequency is accelerating. Halts that occurred monthly are now occurring weekly. The forces pushing prices higher are strengthening. The suppression mechanisms are straining under increasing pressure. Consider what this acceleration means. Each halt is an admission that natural price discovery would produce results the CME cannot allow. Each halt confirms that the paper-silver market is managed, not free. Each halt validates the thesis that physical supply has disconnected from paper price. The CME is fighting a losing battle. They can halt trading, they can implement collars, they can manage reopenings, but they cannot create physical silver. They cannot force Eastern buyers to accept paper settlement. They cannot prevent the arbitrage that eventually connects all markets. Every intervention buys time but solves nothing. The fundamental supply deficit remains. The industrial demand growth continues. The physical premiums persist. And each intervention erodes confidence in the paper market's legitimacy. Now, I need to address the elephant in the room because I know some of you are thinking it. Yes, circuit breakers and trading halts exist in many markets. Yes, they serve legitimate purposes in preventing flash crashes and protecting retail investors. Yes, the CME can point to regulatory frameworks that authorize these interventions. These are fair observations. Let me explain why silver is different. In equity markets, circuit breakers trigger during liquidity crises when market makers withdraw and prices gap violently without fundamental cause. The halt allows liquidity providers to return and market makers to reestablish orderly books. When trading resumes, prices typically stabilize near pre-halt levels because the move was technical, not fundamental. Silver's halts show the opposite pattern. The moves triggering halts are driven by sustained buying pressure, not liquidity withdrawal. Order books remain functional with tight spreads. The price movement reflects genuine demand, not technical malfunction. When silver trading resumes, prices don't stabilize at pre-halt levels. They immediately press toward the same resistance that triggered the halt, requiring additional intervention to contain. This pattern confirms that silver halts are not about stability. They're about preventing the market from reaching prices that fundamental supply and demand justify. The CME would never halt trading in corn or crude oil or copper simply because prices were rising on strong demand. Those markets are allowed to discover prices. Silver is different because silver prices threaten interests that have captured the exchange's loyalty. The regulatory frameworks the CME cites authorize halts for specific conditions. Price movement alone, on functioning order books with adequate liquidity, does not meet those conditions. The CME is abusing halt mechanisms to serve purposes those mechanisms were never designed to address. Let me give you a framework for thinking about what comes next, because frameworks are more useful than predictions. First, recognize that trading halts are admissions of system stress. Each halt tells you that the CME cannot allow natural price discovery. This is information. When the exchange tells you they're afraid of real prices, believe them. Position accordingly. Second, understand that halt frequency signals desperation level. Weekly halts indicate more severe stress than monthly halts. If halts become daily, the system is approaching failure. Monitor halt frequency as an indicator of how close we are to paper market capitulation. Third, differentiate between paper price and physical availability. During halts, the paper price is meaningless. It's a frozen number disconnected from transactions. Physical market prices continue reflecting real supply and demand. Watch dealer premiums during halt periods for the true price signal. Fourth, anticipate that halts will occur at critical technical levels. When silver approaches major resistance levels, halts become probable. This doesn't mean the resistance is real. It means the CME will defend certain price zones. Understanding where halts are likely helps anticipate trading opportunities. Fifth, consider that each halt accelerates the migration to physical. Investors who experience halts learn that paper silver can be frozen, while physical silver remains theirs to transact. Each halt teaches more investors to prefer physical possession over exchange-traded claims. Here's what I believe is actually happening beneath the surface of these trading halts. We are witnessing the controlled demolition of confidence in paper precious metals markets. Each halt chips away at the assumption that COMEX prices reflect reality. Each intervention reveals that powerful interests fear transparent price discovery. The CME faces an impossible dilemma. Allow prices to rise freely and destroy the short seller complex that provides exchange liquidity, or intervene repeatedly and destroy confidence in the exchange as a venue for fair price discovery. They've chosen intervention. An intervention requires hiding the truth from you. The truth is that silver supply cannot meet industrial demand at current prices. The truth is that Eastern buyers are paying sustained premiums above Western paper prices. The truth is that short sellers have created obligations that cannot be fulfilled through physical delivery. Every trading halt is designed to prevent you from seeing this truth reflected in official prices. But the truth doesn't disappear because trading halts. It simply expresses through alternative channels. Physical premiums, delivery delays, inventory drawdowns, arbitrage between markets. The CME can halt their market. They cannot halt reality. Here's my question for you, and I want to see this discussion in the comments. Do you believe the CME's trading halts are legitimate stability measures, or do you believe they're interventions designed to protect short sellers and suppress prices? Your answer reveals how you interpret exchange authority over price discovery. Drop your thoughts below. And if you've experienced trading halts in silver or other commodities, share your observations. This community benefits from aggregating experiences across market participants. Let me leave you with one final thought that captures where we are. The CME Group halted silver trading because they were afraid of what prices would do without intervention. Think about that. The institution responsible for price discovery actively prevented price discovery. They used technical language to obscure their action. Velocity logic, circuit breakers, stability mechanisms. But the truth is simpler. Silver was going up, powerful interests were losing money, and the exchange intervened to protect those interests. Every halt tells you the same thing. The paper price is managed. The physical price is real. And eventually, managed prices must converge with reality or the management system fails. What they're hiding from you is not complicated. They're hiding the fact that silver should be trading higher, much higher. And the only way to maintain the current price structure is to prevent free markets from operating. You now know what they're hiding. The question is what you do with this knowledge. This is Finance Reborn. It's today's date, and the CME just revealed their desperation. Trading halts, managed reopenings, price collars, all designed to hide one simple truth. Silver's natural price exceeds what they can allow you to see. If this breakdown helped you see through the noise and understand what's actually happening, hit that like button, subscribe to the channel, and share this with someone who needs to understand what exchanges are hiding from investors. Stay sharp, transform your financial future, and I'll see you in the next one.